Hello, my name is Elliott. I'm editor of Personal Finance as well as the Energy Strategist. I want to talk a little bit today about the energy markets and oil in particular. Obviously, oil prices have trended higher since their midsummer lows, now up over $90 a barrel here as we approach the end of 2010. I've been predicting for a while that we'd hit $100 a barrel by the end of this year, and I may be off a little bit, but I was at least directionally correct. And I certainly think that by the very first part in the first quarter of 2011, we will see oil prices rally above $100 a barrel. And I think it's very possible we'll see a spike to $120 a barrel at some point in 2011. How do we play higher oil prices globally? Well, I think actually the sector that you want to watch most closely is the services and equipment stocks. What we're beginning to see, and actually the subject of the next issue of the Energy Strategist, is going to be talking about exploration spending. Now, companies typically, when in early stages of a cycle, they spend more money on developing their existing reserves. In other words, squeezing a bit more oil out of existing proven plays. But as oil prices remain higher and sustainably at higher levels, you start to see more interest in exploration work, actually going out, drilling, looking for new sources of oil, seismic activity. Seismic being use of sound and pressure waves to sort of map underground rock formations and try to find new pockets of oil and natural gas. So this cycle really started with, we had a boom in oil prices obviously in 2007 up through the middle of 2008. Oil prices collapsed from mid-2008 through early 2009. As a result, we saw companies cut back on all spending. Sometime in the middle of 2009, early part of 2010, we saw companies come back and wanting to spend a little bit more because oil prices had rebounded. But mainly their spending was on existing fields, known fields, not so much on exploration. I think 2011 is going to be the year where we see a lot more spending on the exploration side of things, actually going out and looking for more oil. Now, as I mentioned, some of the main plays on that would be your oil services and equipment stocks. On the services side, some of your big services providers like Schlumberger are involved in seismic services, actually going out, mapping those underground rock formations, looking for more oil and gas. There are also some pure play seismic producers, most of them listed in Europe. An example would be Petroleum Geoservices. It's a company I'll be writing about in the next issue. And some pure plays like that simply on seismic, which is really one of the first places you see a pickup in spending when companies are interested in exploration again. Other services involved there, of course, are services related to drilling. Again, your usual suspects are going to be involved. Your big four services firms like Schlumberger, Weatherford, Baker Hughes, and Halliburton. But certainly all those companies are going to benefit from the uptick in exploration spending. Another area to watch a little bit further down the chain is the equipment side of things. There has been some increased interest in building new rigs to go out and do drilling. Companies like National Oil Well Varco benefit from that because they make the equipment that goes on rigs. Another company I've been writing about in the Energy Strategist a lot lately is Dresser-Rand. They make equipment used on rigs as well. A little bit further down the line from that, we have companies that are involved in doing things like making subsea equipment. Subsea equipment would be things like subsea wellheads, subsea trees, subsea pipelines. This is equipment used in deep water fields, which is the subject of a lot of the exploration spending that we're seeing. This is equipment that actually sits directly on the seafloor and is used to produce oil or gas from these wells. So any company involved in building that equipment to enable this type of development should do well in an environment of increased spending, which I think we're going to see next year. Thank you very much.